Hello, and welcome to another session of Moneyfy Mantra, a webinar series where we speak with industry experts on various personal finance topics. This shall help our viewers get educated on, various personal finance topics and empowering them, to do their investments more efficiently. So today's topic is very special, and I'll just cover a brief introduction before that. When I was very young, to ride a bicycle, I had to learn balancing. Every employee wishes to have a work-life balance. Balancing is the key to everything, and we do, and everything what we do, think, say, eat, feel, requires balancing. And to extend this, to investments, every investor also needs to have a balance between various asset class that they invest into. So today we would talk about one very important topic, which is one of the critical categories of mutual funds, which is balanced hybrid funds. To talk on this topic, we have Mr. Anunaya Kumar, President and National Sales Head at IIFL, erstwhile IIFL, and now 361 Asset Management. Welcome, Anunaya Kumar, to our show today.
Thank you, Harsh. My pleasure.
So just to give a brief introduction about Anunay, he has over 2 decades of experience in corporate banking and retail banking, wealth management, asset management. And he has been around in the senior leadership positions in various big organizations like Invesco Mutual Fund, IIFL Wealth, DSP BlackRock, Royal Bank of Scotland, IDBI Bank, and Tata Finance Limited. So just to start this topic for today, Anunay. So if you could just give a very brief introduction on balanced hybrid funds.
Thank you, Harsh. And I think you have picked up a very pertinent topic, which is the balance, whether it's a part of our life or the investment. A balanced approach always has a relevance. So what has happened is, SEBI has created a category called hybrid. And within hybrid, there are 3 subcategories called conservative hybrid, balanced hybrid, and aggressive hybrid. What differentiates amongst the 3 hybrids is an equity allocation. A balanced hybrid is a section wherein you can have an equity allocation between 40 to 60. This is a category which got introduced while there aren't too many funds right now in this category, but this is a category of a hybrid which is there.
So Anunay, for the next question, if you could give us more details about allocation of equity and debt in the balanced hybrid fund.
Sure. So what I'll do is, can you see my screen?
Yes. Now we can see.
This is what balanced hybrid fund is all about. As you can see, basically it allows you to have an equity allocation between 40 to 60, which you can invest across the market caps, and the rest gets invested in the debt. The good part about this,
I just I think the screen which is there is the first slide of the presentation.
Just a minute. Why is it showing?
Yeah.
Can you see this now?
Yeah.
Okay. So as I was mentioning, balanced hybrid fund as a category allows you to take an equity allocation between 40 to 60%, as you can see on the screen, and the rest would get invested into debt. Well, you can invest money across the market caps. One of the advantages of the balanced hybrid is that it allows you to take 20% indexation benefit as a part of the long-term capital gain, which is a big advantage that you draw while investing into this fund. It does invest into both equity and a debt. There are no exposures to arbitrage or any other asset class in the balanced hybrid funds.
So the other pertinent question which comes for us, usually investors have bifurcated their portfolio into a long-term portfolio, which is kind of a core portfolio, and they usually want to take a tactical allocation to certain asset classes. So where do you think balanced hybrid funds would placed in an investor's portfolio? Will it be a core or a another satellite kind of an approach?
Can you see the screen?
Yeah.
Okay, so basically, as you could see, this is one of the strategy which gives you best of the both the worlds. It allows you to take, self defined asset allocation between debt and equity. It is the one which gives you a complete indexation benefit. It allows you to diversify between the two asset classes, which is debt and equity. It helps you do the self rebalancing with the flexibility of the fund manager deciding on how much of asset allocation should be done in which class of asset classes. And by virtue of all of these, you are able to have a much better risk management tool, which basically means that through a balanced hybrid fund, which is one of the hybrid structure, you are able to have a much better balanced experience for a client, which is something is core to anyone's experience. And hence, we strongly feel that the balanced hybrid fund should be a part of any client's portfolio.
Right. So, we've been talking about stability, which it brings, investors' portfolio. And predominantly we have seen, investors chase returns over stability. Sometimes they like small cap when, it has suddenly given, 40-50% returns, and, sometimes then they, move to a large cap fund where, when the small caps, start becoming more volatile. This is more of a DIY approach of investing that, has resulted in this phenomena. And what is your message to these investors, and how should they approach this fund to bring more stability in their investing?
See, my message to the investors is very simple. First of all, please appreciate the very fact that the wealth management is something which should be core to your behavioral. And hence, rather than trying to keep it do it yourself, you should always go and take the advice of a professional advisors. There is something which we have seen, look into the rear view mirror approach. So as you rightly said, what has given returns to you is going to give returns in the future. There is no guarantee to it. That we all use a disclaimer saying the past performances have no relevance in terms of an experience that we can offer in future. And hence, it is very, very important that an asset as an individual and as an investor, you should always consider asset classes, be it whatever asset class that you would want to pick it, or putting a lot of impetus on an asset allocation. These are very, very critical points when you look at building the portfolio. And all of this, very difficult to understand and deliver and execute if you try to do it yourself, because you will normally get influenced with a herd approach with some superlative returns in the past, and you start chasing them. I don't think that's the right approach. The right approach is at any point of time, which asset class and to what extent that asset class should be owned is a critical to wealth management or a wealth creation.
Correct. So, we've seen a recent rally in the equity markets where, Nifty is about 19,300, 400, and has been rallying around that. So do you think at this point in time, when, someone has a very large exposure to equity, as an asset class, so should they be moving a part of that to a hybrid fund like this?
See, what we have seen is, can you see?
Yeah.
Yeah, can you see this current valuations?
Yes. No, we are invested into balanced hybrid fund. Yeah. Why invest in balanced hybrid fund?
Current valuation is visible to you or no?
No.
Okay, just a minute. The screen, I don't know for what reason it is slow.
Yeah, I can see it now.
Is it better?
Yes.
Okay, so this slide tells you that if I go back last 23 odd years, the markets have always maintained a price to book bit close to 3.1. If I add one standard deviation to that, the price to books have normally shown a resistance around 3.8. And where are we today? We are at 3.6. Now, this is a classic time that as an investor, one should be very careful, how is one, building his portfolio and moving on. And at times like this, when the markets are no more in the zone of adequately priced, like bit of a premium is visible, then it is very important that one should take a balanced approach and a balanced hybrid, wherein you get a allocation to both equity and a debt has a far and more relevance. So we will strongly advise that a person and any investor at this time should be subscribing to balanced hybrid as a fund.
Correct. So sir, we've been seeing that, asset allocation play a very important role, in creating investors' portfolio. So what are the key points that one should look into and why asset allocation is, extremely important?
See, the good part is if you would go back in the history, you would have seen that these asset classes behave very differently in a different points of time. The correlations are very, very low, and you would see the zones of positive and negative in both the sides. In a situation like this, when the correlations are so low, and we know that the markets have a habit of behaving very, very differently in a different point of time, the key to your wealth creation is to look at a good asset allocation strategy, which practically would mean in your portfolio, both debt and an equity should have a role to play. Please be appreciate the very fact debt offers you stability, equity gives you growth. A stable growth, which is the objective of any investor today, can easily be attained if one is looking at a good asset allocation between debt and equity, and hence it is very important for one to have it in the portfolio.
Correct. So, coming on to the next question, I think it's a very important one, which talks about risk-adjusted returns. We've seen investors, see returns, but they haven't, ever heard of risk-adjusted returns. If you could, throw some light on, what is risk-adjusted returns and why look at risk-adjusted return than just normal returns?
Can you see the screen? Volatility returns and everything?
Favorable risk and return. Yeah, correct.
So as you can see in this slide, the moment you increase the component of equity in the portfolio, it comes with an element of volatility and it comes with an element of returns. So obviously, higher the risk, higher the volatility, and higher would be the return. No doubt about it. We all love seeing the returns coming into us. Look at 1 year, 3 year, 5 year, 10 year. Across the time frames, if I compare an aggressive hybrid or a hybrid composite with a 65-35 being a debt and equity has delivered a better return than a normal composite debt 50-50, which is a balanced hybrid. But if I look at the extreme right bar chart, that's where you can see the returns that you are getting and at what cost those returns are coming, which is return adjusted to volatility. The scenario changes completely. A balanced hybrid gives you a favorable risk return experience. Please appreciate the very fact, while return makes a lot of sense, but the real world that an investor should always be considering while looking at creating his wealth is the risk-adjusted return. As you can see, while equity can give you a far better return or a much better experience, but it comes at a volatility. And if you would want to look at returns adjusting to those volatility, then the hybrid composite index, which is a 50-50 product, has a better approach to look at it. Unfortunately, Harsh, we don't talk about risk-adjusted return. We only talk about a return. The shades of green looks good, but at what cost those shades of greens are coming is equally important for an investor to consider.
Correct. I think, when we also talk to our investors, in our meetings, we bring this point up. Usually investors are, running for returns, but, it is very important to have that quantification of how much returns I'm generating by taking per unit of risk. So that becomes a very important factor for any investor. So any investors looking at this video, they should go and do more research about risk adjusted return when investing. So the next question that most of our investors usually have in mind is why risk managing risk is more important. I think one of the tools that that has been helping all the investors to manage risk is coming through the SIP route into investing. So can an investor invest through SIP in this particular fund?
Oh, absolutely. I think, SIP is a function of your investable surplus as and when it gets generated. My take is, what are we talking about? We are talking about investing into a fund which is giving you a far better stable return over a long run, long period of time, and we are looking for a better experience. That doesn't bar you from getting into the market through an SIP, because at the end of the day, if you would want to build a position in a fund and you don't have a surplus on a day zero, obviously you're going to take a staggered approach to build it up. Just because the element of equity is slightly less cannot be an argument to build to say that, look, I don't want to build it in, I don't want to take this fund in an SIP mode. No, we are talking about an asset allocation strategy. Either you do it in a lump sum or you do it in a staggered phase is a function of how your cash flows are available to you.
Correct. So, I think the talk of the town has been balanced advantage fund when we talk about hybrid as a category. So, could you put some light on what's the difference between a balanced advantage fund and a balanced hybrid fund?
So it's very simple. In a balanced hybrid, as I had mentioned to you, we only look at two asset classes, debt and an equity. And the ratio of equity and debt, equity cannot go beyond 60 and it cannot be lower than 40. The range is between 40 to 60. The moment you get into the world of balance advantage, the element of arbitrage comes in. And by virtue of arbitrage, you are able to maneuver through your equity piece by getting the element of arbitrage into it. Why? Because you cannot come below 65% on equity. So that's the key difference between balance advantage and a balanced hybrid. Why? If I look at the stability part, I think because you have a debt component in the balanced hybrid fund, and as we are going to the way we are looking at our own fund, we will not be taking a maturity, a more duration of more than 2 to 3 years. We are looking at a lot of stability by only having AAA to the extent of 80%. And if I have to look at beyond AAA, we will not go beyond 20%. So what am I trying to say? I'm trying to say is that non-equity part of the portfolio is getting you stability. It's getting you, that AAA, exposure. And while doing so, there is a coupon that is indicative coupon that also you can have in mind. The volatility element is far lesser over here. But the moment you look into arbitrage is again a market-defined approach, so that can be a little volatile in terms of return deliveries and all. So, but yes, one element of arbitrage is completely missing in the balanced hybrid, which is there in the balanced advantage. And by virtue of that, obviously the taxations are very different. Balanced hybrid has got a debt taxation, but you can also have an indexation benefit. Balanced advantage fund are taxed on an equity basis. We have done some analysis and all, and what we have figured out that if you see the differential on a long-term capital gain taxes between a balanced hybrid and a balanced advantage, the differential is only 50 bips, approximately 50 bips, which is where investors pay higher in a balanced hybrid taxes than what you end up paying in a balanced advantage fund.
Correct. So, as you briefly spoke about, there's an upcoming NFO on this particular category from 361 Asset Management. Could you give us more details about this NFO so that our viewers could look forward and do more research and look forward to investing in this NFO?
Yeah, so as I had mentioned to you, the balanced hybrid as a category allows us to have between 40 to 60% of an equity allocation. Exactly, we are trying to occupy a space in that category, which is where our balanced hybrid 361 balanced hybrid fund comes into picture. The way we are going to be managing is, while it does allow us to go between 40 to 60% of equity, but we will keep the range between 40 to 50 only. The benchmark allows us to take 50% equity and a 50% non-equity, which is the benchmark. We'll try to keep ourselves aligned with the benchmark, and hence we will not try and go beyond 50% of an equity allocation. As I said, our debt would be largely stable. We will keep the debt exposure up to 80% in AAA, or rather 80% and above in AAA, and up to 20% would be AA plus. Little bit of government securities we can look at if we see an opportunity, but keeping in mind that our modified duration will never go beyond 2 to 3 years. Equity part of the portfolio will be absolutely bottom up, and the idea is it's going to be managed like a multi-cap fund. So that's where this NFO is positioned.
So, as you mentioned that, the equity allocation would be, managed in a, bottom-up approach. Would you give us more details about, who would be the fund manager, who would manage the, equity component of this fund?
Oh yeah, sure. Mayur Patel is going to be the manager for our equity fund. He is with 361 Asset for more than 5 years, and currently also responsible for managing our active mutual funds, which is focused equity fund and flexi cap fund, and he is going to be responsible for managing this fund as well.
Yeah, and this NFO will be starting from which date, and how many days does the investor have until it ends?
Oh yeah, so the NFO starts on 4th of September. The fund will be available during the NFO period, which is till 18th of September, and then the fund will get reopened for a fresh subscription on 3rd of October.
Okay, so one last question is, who should look forward to taking exposure to this particular NFO? As in, which category of customers should look forward?
Yeah, sure. Thanks. It's a very interesting question, because to me, actually, everybody is should be looked upon, because asset allocation is a need for everyone. But to be very specific, I think a typical debt investor, the investor who has got debt in the portfolio because of the recent taxation changes, is happy to consider some bit of an equity in the portfolio, but would want to have a large exposure to debt and some bit of an exposure to equity. Why? Because objective is to look at indexation as a benefit. I think certainly this is a fund to look at, wherein you can have a larger portion of exposure to the debt, and yet you are able to get an indexation benefit. It makes a lot of sense for the fence sitters, the people who aren't getting the courage to move into the market because they find equities are always very expensive. Little bit of they can consider this fund to invest in. Retired people who are not very keen to take extraordinary risk in the portfolio, they can look at this fund. It makes a lot of sense for the people who take a very balanced approach. They would always consider, asset allocation the key to their wealth creation. I think something which can give you 50-50, 50% on equity, 50% non-equity. I think this is something which is very close to their aspiration, where we can keep between 40 to 50 on the equity side. So these are a set of people who should be looked upon. Considering the market of today, as I was mentioning to you, at a 3.65 on a price to book, I think it does make sense for every investor to build some kind of stability in the portfolio, which can come into this fund.
Correct. So I think, Anunay, we've come towards the end of the episode today. Thank you very much for patiently answering all the questions. It will really help our investors to look forward and go forward to review this particular NFO. So any closing remarks, Anunay?
No, I think my closing remarks would be very simple, which is please trust your advisors. I think they are the best men who understand, because this is, at the end of the day, this is a job of a professional. Well, I understand people do manage the stuff on their own, but they do come with their own set of risks and challenges. Second thing is, while we have been talking about return, everybody loves the shades of green, but let's be cognizant about the fact that at what cost those shades of greens are coming. What I'm referring to is returns are good, but risk-adjusted returns are better. Last but not the least, While selection of funds have a role to play, it does add alpha to your portfolio, but the real wealth creation happens when you do a right asset allocation. So keep these things in mind: a right asset allocation, a risk adjusted return, and taking the advisory from a professionals. I think these are the three key elements. If you follow them well, nothing can stop you creating wealth in a long run.
Thanks, Anunay. So just to our viewers, anyone who is, looking forward to opening an investment account, you can download Moneyfy app, by clicking on the link given in the description below. If you wish to start an SIP or a one-time investment in this NFO, please visit our NFO section. This fund will be live, on in the